Great. Good morning, everyone, and welcome back to day 2 of the ETC Summit. I think this will be a nice and welcome change of pace from some of the other presentations that you've seen thus far that have primarily focused on development. So this is a panel that's going to be focused on trading and investment activity, primarily from an institutional perspective. So with that said, my name is Matt Beck. I head up product development and research for Grayscale Investments. Grayscale is now the largest cryptocurrency asset manager in the world, with approximately $1.5 billion in assets under management across 9 different investment vehicles. And we've always been particularly close to the ETC community because the Ethereum Classic investment trust is our second largest product in terms of AUM. We were an early investor, and we've obviously developed some deep ties with the developer, marketing, and global ETC community. I'm fortunate enough to be joined here today by 3 titans of the crypto investment industry on the trading, research, and then portfolio strategy front. So to my left, I have Tom Lee, who is the managing partner and head of research at Fundstrat Global Advisors. To his left is Jack Liu, who heads up Asia Pacific trading for Circle. And then to Jack's left is Michael Moro, who is the CEO of Genesis Global Trading and Genesis Capital. So I want to thank you guys for taking the time to join me here today, and really just looking forward to having a pretty informal and fun discussion. We can liven it up a little bit and just have, share some different perspectives. But I always think it's interesting to start by just learning about how you guys first got bit by the cryptocurrency and blockchain bug and how you fell down the rabbit hole. I think it's something that takes a conceptual leap to start to appreciate that crypto assets are a viable investment opportunity or a currency. So Tom, let's start with you. Just why don't you tell me a little bit about how you got involved in the space?
Sure. I'm actually fairly new to this space, but I came through it really through a research angle. Before founding Fundstrat, which I founded in 2014 with my partner John Bay, I was the chief equity strategist for JP Morgan, and a firm I'd been at since '99. And Bitcoin was something that the macro team talked about a lot, but it was really covered primarily out of our FX department. And at that time, John Norman sort of postulated that at some point in the future, maybe Bitcoin could become a legitimate currency. But he generally, and this is 2012, 2013, was pretty negative overall because its use was primarily on the dark web. And so he thought it was really for the realm of drug dealers. And I think that's one reason why Jamie sort of tended to view it that way. And when you work at a large firm like that, it's difficult when someone has domain expertise to develop what we call a variant argument because you don't really want to necessarily just get into an argument with the FX guy. So we founded Fundstrat in 2014, and Bitcoin hadn't done much from the time we founded Fundstrat, but then it began to really rally. And so last year, our team decided, because 3 of the 4 research sort of seniors at my firm are from JP Morgan, so we decided to take a look at Bitcoin and just wanted to answer, is there a simple way to look at it through a simple lens? And we just found it was actually probably a really good substitute for gold, digital gold. So that was really the genesis of our sort of research, and we've been interested ever since.
And Jack, how about you?
Yeah, I think today people think I'm a true believer, and I really am. But I think very few people know that I didn't discover Bitcoin until 2013. And that feels early now, just like in 10 years' time, today will feel early. But in 2013, I was working at Barclays in traditional finance in Hong Kong, and felt to me like finance had not really changed while the rest of my life was changing, using WhatsApp, iPhones, and Uber, etc. But the financial industry, as a young person on the trading floor, felt a lot like the descriptions of Liar's Poker and things from the 80s. So that felt a little strange to me. And I went to Silicon Valley and moved there, quit my job without having heard about Bitcoin, just thinking about something about fintech. And luckily, it was almost like a dream come true. Discovered Bitcoin about a couple months in, and tried to get myself into the space as much as I could. So early on, it was through blogging, and then I've been really, really fortunate. So had the chance over the last 5 years to work with Jesse at Kraken in 2014, and then spent 3 years in Beijing with OKCoin, where I was Chief Strategy Officer, and now kind of taking on the next stage of my career, the past year expanding Circle's trading operations into Asia. So from that perspective, I've seen sort of the really grassroots, libertarian, ANCAP kind of perspective of Bitcoin, the Chinese sort of more profit-driven, more realistic perspective, and then the Western sort of, I would characterize as more traditional-minded, regulatory-focused, institutional-focused perspective. And I think they all have their piece in the space, and it's been a fascinating experience.
And Mike Moro, I think I know your story pretty well, but why don't you go ahead and tell the rest of the audience?
Whenever someone asks me, when did I get bit by the crypto bug, it was actually way more like hit over the head with it. Barry, you over there? That's him. So he's the one to blame for how we all got into the crypto space at DCG. Back in 2013, actually this is throughout 2012, as Barry was becoming an evangelist of crypto, he really wouldn't stop talking about it at the office. And we were second market at the time, and we were already trading all kinds of illiquid, off-the-run financial assets. And so late in 2012, early 2013, I think, is when we said, okay, we're already trading a whole bunch of other random financial instruments. Bitcoin could be yet another asset class. And so we did, without knowing a heck of a lot about who was involved in the space. Barry just handed us his Rolodex, all of his contacts that had kind of developed early on in the space, and said, okay, let's go find some buyers and sellers. And that's really how the second market trading desk operation sort of started. And then we formed Genesis in 2015. So we've always been sort of an over-the-counter market maker, geared towards institutions, really, really kind of early on, and here we are, 6 years kind of into the run.
Great. So you guys all kind of come from traditional trading and investment backgrounds, focused on other asset classes. And so I'm curious, what do you see as the most striking similarities and differences between crypto assets and traditional markets like equities, bonds, commodities, et cetera?
Sure. Yeah, sure. I think the similarities is, as you say, is an asset class, and as people have branded that, it's become easier for the everyday consumer, also for the institutions to accept sort of where this might fit into their portfolio from a diversification strategy. So I think that branding has been correct. But I think what's sometimes lost now in the last year or so is people misunderstand that this asset itself can actually be used, and it must be used in order for sort of this financialization aspect of crypto to actually work. And so it's not really like bonds and stocks where it just represents something. The asset itself is something that needs to be used by people for different applications on the actual chain. So whether you are using it to store files or you're using it to use as payments, you have to actually use the coin. So if we kind of have too much of this institutional kind of baskets and derivatives and receipts and things like this, that's important for the aspect of the old economy that cannot actually touch the chain. But if we don't have enough development or support or awareness on the on-chain activity, then the two have a relationship, right? That's like the company earnings that you're trying to invest in. So I think that's the thing that we have to make sure we have a right balance on.
Mike and Tom, anything to add?
I mean, that really does explain it well. I guess I just make two additional observations. One is, unlike other markets, the price variations are so different across geographies. That's something that's really almost surprising to see. And the second is because there isn't a traditional fundamental way to value crypto. It doesn't pay a dividend, and there's no pledge of collateral assets. It seems like price momentum plays a much bigger role in actually how crypto behaves. In the traditional financial world, because I used to be an equity analyst, I used to cover wireless stocks. you actually always bet against the crowd. So I would say that more than 60% of the time, you were successful as a contrarian. I think in crypto, the time to be a contrarian is only at the extremes, and most of the time you have to bet with what the crowd's doing.
I'll add to that. So I think two different things. I think one, the products and services you'll see in crypto, and it's sort of starting to get there now, but within a couple of years, I think it'll be very, very similar to kind of what you're seeing in the equities and fixed income space. I think the institutional investors will come to expect the same products and services that they see in stocks and bonds and other commodities, and you'll kind of get that in crypto. So I think you will continue to see the futures, the forwards, the options, the shorting, the hedging mechanisms, all of those things that you'll see in other markets start to kind of appear, pop up, and continue to kind of grow in the crypto space. On the other hand, how is it unlike anything that we're kind of seeing is just how retail dominated this market really is right now. In other markets, you've kind of seen the institutions kind of lead the charge and still continue to be the majority portion of sort of what you're seeing sort of on the volumes, especially on the commodity side. Here we are in crypto where, still 90, 95% kind of dominated by retail, where institutions are clearly the lagging part of the investor base.
Yeah, and so you mentioned the introduction of futures and options and derivatives on Bitcoin, which I think segues really nicely into my next question. It's only been over the last 9 or 10 months that these products have been available, and I'm curious if you're seeing more of your clients using them as risk transfer or risk mitigation instruments, or if they're actually using them to directionally short, which might be putting some of the pressure on the Bitcoin price that we're seeing today.
My view is that it is a directional bet, and not as much on the hedging side. Hedging obviously requires institutions to actually hold the underlying crypto on the other side, and simply because the small percentage of institutions that are truly playing in the space, and the people that are really doing this from an institutional perspective want that upside. So I don't think they'd hedge that away, just in case you really get that pop. And then you get that one pop you're kind of hoping for, but you were fully hedged out on the price side and you kind of missed it, right? And so if you have institutional investors that are having that lottery ticket mentality, where they've only invested 50 basis points, 1% of their total AUM, they don't really care about sort of the 60 to 70% kind of pullback that we've seen this year. They're still kind of hoping for that 5 to 10 years out. So I do think that they are taking kind of directional bets. However, what I think the introduction of the derivatives market has certainly done is widen the investor base. No longer do you have to hold the underlying crypto to have exposure to the asset class. So I think that what it's really done is, yes, it may have added kind of a continuous selling pressure, but these are all brand new investors that have now kind of played around in crypto. These are not the same guys that have been playing in the space for years and years. So I do think that it's been a positive for the space, certainly in that sense.
Great. And Tom, you recently put out a report, I think a few weeks back, talking about Metcalfes Law as a way to measure, a potential valuation for Bitcoin and other crypto assets, and you use that as a proxy for the network effect. So I'm just curious. You said it explains about 70 to 80% of the price change, and can you just talk to us a little bit about Metcalfes Law and explain what that is for the audience and how you use that to come up with potential valuations?
Yes. So Metcalfes Law, it refers to a study actually coined by Metcalfe. I don't know, it's Robert Metcalfe. He's a professor at MIT. But the concept actually belongs to George Gilder. So if anyone is old enough to know who George Gilder is, I'm impressed. He was a telecom guru in the late 90s, and he was postulating this idea that the value of a network is not a linear function of the user base, it's actually a log function. So if you double the user base, you actually have a 4x increase in network utility. Interestingly, social networks are really explained by this. So I'll talk about my presentation, but like if you looked at Fang and you didn't know the Fang business model, but you just bought Fang based on a belief that internet users globally would grow, you would have captured 75% of the return of Fang. You didn't have to analyze it. And so the idea is These cryptos actually, are they explained by how many active users? And so we published several pieces on this, but the most recent one was we looked at like the top 10 protocols, and the lowest explanatory value was like 50%, and for Bitcoin it's over 70. So the value of Bitcoin is basically explained by the community growth itself.
Yeah, and I think that has important implications for Ethereum Classic in particular because, as Anthony mentioned in his discussion yesterday, we're kind of seeing an increase in all the various micro metrics that are indicative of the health and growth of the network. So I certainly think that's interesting. Mike and Jack, I'm also curious to get your perspective on the trading side of things. So what are you seeing from the investors that you're servicing in terms of the types of signals that they're trading on, and are the majority of them long-term holders, or are they short-term active traders?
I think there's a range. I think the players who have been in the space for a while, they are obviously have a lot more crypto holdings, and they're looking to sort of sell at different points of time. And the ones that have taken the longest to convince to kind of come into the space, whether it's from like several meetings or compliance or ones to get comfortable around this, they actually come in and be very much a long-term holder, and they have a much longer-term perspective. And some of them, I feel like they feel that there was something missing about Bitcoin in their view, or something missing about Ethereum, and the new sort of protocols can kind of capture their imagination. And so you're actually seeing quite traditional VCs or traditional institutional investors take long-term bets on like longer tail coins. Actually, that's a little interesting perspective I have. And obviously the
Venture style.
Yeah, venture type. They're taking a venture bet on some of these projects, and that's contrasting with sort of again the OG type of people who are very much hardliners towards either Bitcoin, Bitcoin Cash, Ethereum, Ethereum Classic, Zcash. These are the core names.
In getting ready for this panel, I was looking at some of our own trading data to try to figure out some of the insights regarding ETC that we've seen at Genesis. And one of the interesting things that I was sharing with Matt earlier before we started this panel is that on the OTC trading side, it really has, the dollar volume that we've traded has really mirrored kind of the relative market caps between ETC and ETH, almost scarily so. And where today you have ETC kind of sitting around 5-6% of kind of ETH's market cap, that is exactly roughly the ratio between ETC and ETH on the pure over-the-counter trading side. Conversely, Genesis is also the authorized participant for Grayscale's products. And dollars into the ETH trust is almost exactly the dollars into the ETC trust so far in 2018. So the relative market cap differential doesn't exist for the Grayscale products. And what does that mean to me? One, I do think that volume, liquidity, short-term trading mentality really does drive the OTC side, whereas the trust investors are certainly doing this for longer-term investment. And so whether or not that's because ETC holders are okay with the 12-month lockup and kind of the longer-term investment horizon, or people just simply see ETH as a trading mechanism and are less willing to kind of invest it and kind of hold it in the long run. But I thought that was an interesting piece of correlation sort of data that we saw.
Barry's branded himself very well as an ETC supporter.
Yeah, and I think jumping to the next question, Tom, something that you and Sam Doctor, I know, have also looked into is kind of the value mining cycle. And what I mean by that is it seems like, when ETC or Bitcoin's price goes up, you have mining capacity coming online, the difficulty goes up, but that can also unwind very quickly, which leads to sharp spikes in volatility. So what are your thoughts on the role that mining plays in market cycles? And is this a risk that investors are just going to have to accept because it's sort of the nature of the beast?
Yeah, I think when you look at the security side of Bitcoin and the mining, it is really the most corporate, right? It's true profit incentive based. And I think in the downturn, I do believe there's a misconception. Large miners, when Bitcoin's price and Ethereum actually downturns, they're not necessarily net sellers. And we've talked to a lot of miners about this, that in general, because they know the ROI of producing a crypto coin, they'd rather hold it. But when prices are high, they actually tend to be sellers. So I think in a way, miners are actually acting as a stabilizer. They're not actually worsening what's happening in crypto. It may change when Bakkt becomes available and they can actually do physical delivery. But the cost of mining actually is playing a role that most people don't appreciate. And we're going to see it truly tested. But in 2014, when Bitcoin bottomed, in January 2015, it bottomed at 180. If you took the best GPU miner or ASICs at that time, the break-even cost for mining was around 180 to 200. So Bitcoin actually bottomed in 2015 at around 1 times mining cost. Today, that 1 times mining cost is around 6,000, and we've seen Bitcoin hold that level a few times.
That's interesting. And Jack and Mike, do you have any thoughts on the role that mining plays?
I've watched Keen Lee Tom's analysis on the mining cycle, and I tend to agree with it very much so. And I think one of the reasons you're seeing the mining players looking to the capital markets to go IPO, a number of them, is we're creeping closer and closer towards sort of the break-even point for miners, which is maybe estimated at 5,000 US or so for Bitcoin. And it helps to have an outside balance sheet to kind of sustain yourself in the game. And if you look at how Bitmain kind of dominated the 2016, 17 cycles, it's because during that downturn, 14, 15, that's when they were able to continue to produce better equipment, deploy more scale in the face of other miners not being able to do so.
I think for us, we actually love it when miners are selling. Just having a natural seller every day is huge to sort of figure out your kind of daily flow. And so certainly for the coins that Genesis is making a market in, having sort of that natural seller every single day is a fantastic source of flow. And when they stop selling, it obviously kind of makes it harder for us to have to go source a certain bunch of tokens every day. So I don't really think that, certainly for our experience, that it adds that much kind of additional selling pressure. It actually is a nice offset to some of the buy-side demand that we'll kind of see every day.
So as we look out into the future, I'd be curious to get your thoughts on what you think the biggest headwinds and tailwinds are for Ethereum Classic specifically, just because, obviously this summit is focused on ETC, but also for the broader crypto market.
Sure, I'll take a shot. Because there's so many tokens in the marketplace, I think differentiating one from another, at least for the institutional investors, is impossible. And so I think there's a lot of effort that needs to be done around education, awareness, marketing, branding, all of those types of things, even within the top 15, top 20 crypto space that ETC currently is. And so I think it'd be really, really difficult for even some of these guys who have looked at the space to really tell you the key differentials and kind of the value proposition differences between the two tokens, or between this and Litecoin or Ripple, like things that have absolutely nothing to do with one another, but I think people will still have a hard time differentiating. But I do think that comes with time. Investors certainly were still getting familiar with Bitcoin, 12, 24 months ago, are now starting to look at the other coins. And I think as the education, as they kind of go up the education curve, I do think they'll see the differentiation kind of between tokens. But I think there's a lot that the ETC community can do to kind of hasten and further that education effort.
By the way, when we say ETC, isn't the light supposed to be flashing?
Oh, yeah.
Okay, I was just trying to say.
So Anthony tweeted out the blockchain address for ETC cooperative donations, so make sure you're making the light go off throughout the day.
Oh, it's donations, not just saying it.
Yeah.
Minor correction, it's actually the ETC Community Fund. It's run by several people in the community and not the cooperative.
Great.
But it's great.
Yeah, thank you for clarifying.
Got it. I was just waiting for the light
wanted
to
to make a
flash.
comment on that. I go back to my first point. It's just, you got to focus on development and on-chain activity and giving users and developers a chance to imagine like what they can actually build on your protocol. You can't get worried about like will the CME at an ETC like futures. That will just happen as a result of any of these assets truly taking off. So in this space, the smart money isn't the institutionals because they didn't come into the space until 2017, right? The smart money is in the technical, philosophical, like people who want to build a completely different planet. So by the same token, no pun there, but you're not here kind of to, there's so much room for imagination. You're not really competing with even Ethereum or any of these coins. You just have to build a community that is very open, has a certain kind of standard that is focused on development. And again, like the same way the OTC volumes are tracking the market cap, the usage, to combine everyone's points, the usage grows the Metcalfes Law curve, and then that will lead to these products being built. So that's where the focus should be.
Yeah, and I'd just like to add to that, I think Ethereum Classics actually done really well in this crypto bear market. If you look at tokens year to date, only 3 have had an increase in active users. It's Stellar Lumen, EOS, and Dogecoin. And I'm not sure why Dogecoin's up. But Ethereum Classic's pretty much flat, and it's been one of the better performing platforms. So I think that's great news. And again, I think the utility and creating a strong community is important. And I kind of see it here. I think the miners cooperate with developers, and I think that there's the right amount of tension, but solution finding. I also think it's probably good that there is no on-ramps besides traditional exchanges. I think when futures were introduced on BitMEX for Ethereum, it really created a lot of selling pressure. And in fact, we published a piece, I think if you look at the last 6 tokens that had perpetual swaps added, they fell an average of, I think, 47% in the first month. So it's probably good to just do it OTC. Call these guys.
So I absolutely hate when I get asked to make short-term price predictions. So I won't ask you guys to give me your 12-month price target on anything. But as you look out into the future, maybe 5 to 10 years at the investment opportunity associated with this asset class, what do you think the best way to play that is? Is it betting on some of those longer tail coins? Is it allocating to a diversified mix of crypto assets? How do you guys recommend that people play this opportunity?
I think in traditional finance, you have this like dollar cost averaging strategy. And the fun thing about this stuff is you can actually use it. So if you try and move more of your life into the crypto ecosystem, then I think you'll naturally kind of both be dollar cost averaging. Like people who take their paychecks in crypto, I think those things are going to happen more and more often. And that's kind of, again, focus on the utility. So I think in some ways, this market correction has shown that a lot of the hype about last year were kind of maybe misplaced in the wrong areas. And the reason that the market takes a long time to adjust is people actually have a lot of funding. They still are using some of their runway to continue, but maybe those ideas aren't very good. And we need to kind of cleanse the ecosystem of ideas that are on its way to failing to inject new ideas. And the best example I can give is you look at the 2013 narrative of like, let's go get Amazon to accept Bitcoin, and that would equal price goes up like 5x. And let's make a Bitcoin ETF would help drive the Bitcoin price from 300 to 600. And this is the limited imagination that people had at the time about what could you do, because people kind of looked at crypto as a completely different thing and wanted to kind of bring it back into the blockchain, into the real economy, and let's make private blockchains and things like this. And you had to kind of get rid of that train of thought. And the thing that you should have been focusing on at the time was, for example, like smart contract applications. Things are even more abstract than sort of Bitcoin was at the time. And I think what will drive this whole market up the next 10x will be something along those curves, not things that are really part of the narrative from the past year or so.
Tom, Mike, anything to add there? Or a different point of view, perhaps?
Well, I think Fang, for those who don't know what Fang is, it's an acronym for Facebook, Amazon, Netflix, Google, or in China they call it BATS, for Alibaba, Baidu, Tencent, I think Sino. If you bought Fang 15 years ago, you would have turned $1,000 into $1.6 million. In fact, you didn't have to own anything in the stock market since the last 15 years except Fang. And before Fang, in the 80s, all you had to own were consumer stocks like Gap, Home Depot, which actually rose 1,200%. So $1,000 turned into 1.2 million. I think the next Fang is crypto. So I think you need to just buy the quality projects, and $1,000 will turn into, I think Vitalik's right, it's probably gonna be more than 1,000x, from here.
Yeah.
So.
Great. Well, I want to, with that, I think we're running out of time, but I want to thank the panelists for sharing their very unique perspectives. And yeah, we'll open it up to audience questions if anyone has them.
Oh, Barry's got a
Barry.
question. Oh, this is good. Oh, God.
I think the three of you guys have the highest level and I think the most engaged conversations of anybody in the world with institutional investors. What are they saying in these meetings quietly to you? What are they thinking? How do they view what's been happening with the price, and what's really happening behind the scenes?
I think what's been really encouraging for me personally is even throughout the bear markets, the projects, the announcements, things that the biggest financial institutions in the world have been working on now haven't been postponed. They're still being planned. They're still going full strong. And so my sense is if they really thought this was sort of a fly-by-night type of opportunity, then I think the price decline would have put a whole lot more projects on hold or just entirely kind of cancel altogether. But it's the exact reverse that's kind of happening. I feel like banks and some of the hedge funds are still growing their blockchain teams, their crypto teams. More and more you hear about traditional financial players kind of getting involved. And so from a service provider's perspective, guys that are trying to create the roses, bridge, and tunnels of the crypto space are still going strong. So that's, for me, certainly a sign that this is a longer-term asset and that they agree with our view that certainly this isn't going away. But the hedge fund guys, the biggest ones in the world, why they haven't kind of invested, my full view still has to do with custody. And that's not with because the existing custodians aren't good enough. I don't think that's it. I don't think it's a tech question. I think it's a credit question. They need the brand name, the Fidelities, the State Streets, the BNY Mellons to kind of get involved. Not because they can build better tech. I don't really think that. But because there's kind of the brand name associated with each custodian and that they wouldn't be faulted within their company for picking State Street as their custodian, one. And two, in the event of a hack, would they have the balance sheet to make me whole? Whereas some of the crypto startups wouldn't have that. So it's a conversations around insurance. It's a conversation around, it's a CYA type of thing as it results in picking out which custodian. But the moment one of these guys are really kind of involved and we hear rumors every single day, I think you really kind of start to see the movement kind of coming from the institutional guys.
On a general level, I think I agree with you for sure. And then I just had some highlights. I used to read Barry's tweets about what his meetings were about with institutional investors in 2014-15. I think the attitude change has been the biggest effect. So previously, the startups were begging to get a meeting with the institutions. And now, if you think about, there's 2,000 banks in the world, but how many OTC desks are there, or how many crypto exchanges are there? And so they've really kind of embrace that these institutions have a lockdown and massive sort of market share in the traditional financial world, but they've kind of accepted that they are a relatively late or fringe adopter into this space, and they're really looking to learn really humbly about how they can get involved. And previously, these institutions would say they would never have capital on sort of these kind of exchanges that don't meet the kind of the grade, but now they're willing to kind of explore. And the employees of these institutions, when they can't directly access fast enough, they tell you privately, like, hey, I have a lot of this stuff in my own PA, but I just can't do it as part of the institution. And those institutions that are not as embracive of this technology, they are finding that, sometimes I go to a meeting and 6 months later, these guys have set up their own shop outside of the institutions, where sort of talent, even at these institutions, can flow. So the ones that have thought smartly about it are taking a different approach. They're redoing the entities, they're doing things that allows them to access this space at the kind of speed that the retail investors are accessing. So that's been refreshing.
Jack, how would you compare the perspective of the institutional investors in Asia as compared to, let's call it the US or Europe?
Yeah, I think the setup always in Asia was more flexible because there was no sort of 100-year bank, 200-year bank type of deal. And people always looked to Asia, even for the global funds, as an emerging market play or like a strategy where they were already investing a whole bunch of esoteric things. And so those funds are sort of much more nimble, and they don't have as much sort of restrictions on what they can do, and that's helped them because they were able to enter the space a little bit earlier in the maybe 2016, 2017 phase, so they can sort of still be positive on the year or on their fund, and that's helpful. And the entrepreneurs are able to be more nimble with these institutions as well in the space. So they've kind of had a much more open dialogue over the years. I think the companies in the U.S. And Europe are a little bit more traditional, like the startup companies in the space, whether they're merchant adoption or an exchange. You've seen a much more dynamic business model going on in Asia, and that's kind of, again, giving people more imagination on what they're really investing in.
If I could just add a little bit, because I don't want to sort of beat the point too much, but our business, 80% is still primarily institutional, traditional markets. And I kind of view that institutional market is really two. There's a macro world where people trade correlation, and then there's sector funds, which buy sectors and make stock bets. The macro world, I think, is pretty interested in Bitcoin because it is uncorrelated. But as these guys mentioned, custody is an issue, and that's why I think backed is really going to be pretty attractive, and not these necessarily cash-settled futures. And that's why Goldman didn't have much business. But a much bigger pool of money is sitting with sector funds, and whether it's a pension fund or a tiger cub, and that's really where most of the money is. You have to remember, these guys made all their money just buying Fang. I mean, they all got rich being long Fang. $1,000 turned into 1.5 million. Crypto to them, it sounds like the worst idea, because one, it's their neighbor who was unemployed that just made $1 million on crypto. Or the guy they fired turned out to get really rich. And so they kind of resent crypto because it seems like it's not their kind of alpha. They didn't discover it, and it's not their idea. But the reason we're getting a lot more interest from them, and we do a lot more teach-ins, is that they're finding that every analyst they hire from college is pretty active and interested in crypto. So they want to understand why these young people like it so much. So.
Do we have time for any other questions? Anyone else have a question? Okay.
All right.
Well, with that, I just want to thank our panelists for sharing their perspective, and let's give them a big round of applause.